If we're thinking about pricing power and the companies that have it and those that don't, where would you want to put your money? What sectors?
Yeah, we've been looking a lot at this concept of pricing power, focusing on companies that are able to withstand the inflationary pressures that potentially lead to higher input costs and put pressure on some of their margins. Here, we're looking at companies in the tech sector that have good cash on balance sheet, good ROE and balance sheet fundamentals, and are able to retain their pricing power. So they're able to pass on some of those extra costs to consumers without hurting the consumer demand. And also some of these global brands, strong global brands within luxury, but also beyond the luxury sector that are able to withstand that.
I'm really curious what you say about tech, which is interesting because the market often views tech as being a long duration business. Rates go up. You don't want to necessarily own that because you're discounting future cash flow. But what you're saying is that they probably have better pricing power than others. How do I put those two things together and how does it net out?
It's really a relative trade, as you say. So when I think about the equity view here, we need to think about barbelling in our portfolios. So focusing on some of these exposures that do well when rates are going up, looking at sectors like financials and exposures like value, but also focusing on the companies on the other side of the quality barbell, tech, despite the headwind from tightening. And it is, the caveat here is that there's a lot of hawkishness already priced in the market. So despite that, focusing on those names in technology and quality that can do well because of their ability not to hurt consumer demand, their ability to defend their margins.
Okay, so that's on the sector level. What about on a regional level? We saw with the Bank of America Fund Managers Survey, which Guy was pointing out to me earlier, people starting to turn away from Europe a little bit. Are you?
Actually, when we look at Europe, and here I'm speaking about European equities, we've started to see a pickup from ETF flows tilting towards European equities as of the start of the year. And that trend has really continued even in February. So here I'm looking at exposures within the European equity space, like Eurozone equities, so Europe ex-UK benchmarks, but I'm also looking at financial sector exposures within Europe. And that tilt, when we think about Europe's positioning with regards to how much is priced in for the ECB, and as well how Europe is doing in the earnings season that's wrapping up over the next couple of weeks, I think that tilt from investors that we're seeing in ETF flows could continue, could have legs.
People are looking for hedges. They're trying to figure out how they deal with the inflation narrative that looks like it could become embedded for at least a while. We're seeing money moving into commodities and other areas, certainly into the rates market. We're looking at floating loans and what is a much better place to be from a protection point of view when interest rates are potentially rising. But let's just focus a little bit on the commodity story. In terms of the flows that you're seeing, is there any sign that they're slowing down, picking up? Is that hedging process accelerating, decelerating? I'm wondering kind of where we are, how much further or not we have to go in this process.
Yeah, I would really break up that commodity space into two areas where we're seeing interesting trends. The first is really looking at the energy side of things and industrial metals. And the second is really looking at precious metals.
Yep.
Within the first bucket, we have seen some pickup in flows in energy exposures, which is, to be expected given the moves that we've seen in the oil price. And energy producers have really lagged relative to oil prices, so they could continue to pick up from there. On the precious metals side, gold ETPs have started just now, in the past couple of weeks, pick up some demand. It's very nascent, it's very early to call whether that has trends to continue, the gold space. But what is interesting is gold producers, so gold equities, which have so far lagged, and whilst we started to see the first move in gold ETCs, we could start to see that translate into the gold equity sector.
So while we're talking about what we're hedging, obviously inflation is one that people are looking for. What about geopolitical risk, Karim? How do you view that?
I think, of course, the geopolitical risk that we're seeing in markets at the moment does present some challenges in the near term. But when we zoom out, I think a couple of things. First of all, these types of geopolitical events can cause market gyrations and market volatility in the near term, but don't tend to have a very lasting impact on markets when not altering fundamentals. So the other area is really going back to the gold conversation that we just had. I think this is one of the drivers. The geopolitical risks are one of the drivers why we've started to see some pickup in those gold exposures.